Good day, traders. Hope you guys are well and welcome to my channel. If you're new to this channel, kindly do me a favor. Please hit the subscribe button to join our family. Also turn on the notification bell so that you can be alerted for whenever I upload a new video. If you're a returning subscriber, welcome back. Hope you guys are doing okay and hope you guys enjoy today's presentation. In today's video, we're going to be talking about market manipulation. And we're going to be trying to understand why the market tends to hit stop losses of retail traders before it goes into the direction that they had anticipated. Please make sure that you have a notebook next to you and make sure that you're in a comfortable position so that you can be able to pay attention till the end. When you're done watching this video, feel free to keep the conversation going by engaging in the comment section. Without wasting any time, let's get right into it. So I uploaded a video on market makers and liquidity, just so you can have a background. So if you still haven't watched those videos, I'll summarize what I said there now. So now in that other video, we talked about customers and market makers. They want to buy and sell currencies. Now, market makers buy and sell currencies from customers, and they do it for profit. So the reason why the Forex market or the financial markets are so efficient is because there's always a counterpart to a trade. So if a customer wants to buy X amounts or if they want to sell, liquidity providers are there to ensure that there's always a counterpart to that trade. That's why when you place a trade in the Forex market, the trade or the order is filled within seconds. This is because of the presence of liquidity providers. Liquidity providers provide liquidity for profits, and those profits are called spreads. So it's like when you go to Pick and Pay. Pick and Pay is a market make. Think of it as a market make. Pick and Pay will buy goods from a manufacturer at a low price and will sell these products to the customer, final customer, at a higher price. So it's essentially what's happening here. So for as long as price does not move, these people are assured a profit. But then the reality is the market is always moving. What causes these movements? And the simplest answer to that question is resting liquidity. So from that other liquidity video, I did mention that the market is always moving because the orders that are coming into the market exceed the liquidity that's available. Now, you have two scenarios where you have equal amounts of sellers and buyers from the liquidity providers, even liquidity. And when there's even liquidity, the classical or the typical supply and demand model works. If more customers are willing to buy than sell, prices are going to go up. If more customers are willing to sell than buy, prices are going to go down. So there's another scenario that does not happen or does not occur most of the time, but it still does, which is a case where there's uneven liquidity. This is a scenario where the liquidity providers are either more willing to buy a currency than sell that currency, or they're more willing to sell, right? In this scenario, price moves in the direction of least liquidity. So even if there's more buyers than sellers, let's make that example. So I'll use the blue to represent liquidity. So maybe you have 80 orders here and 20 orders. So now you have 80 who are willing to buy from sellers, and then you have 20 who are only willing to sell to buyers. And then the red represents the orders coming in from the customers. This represents the people who are selling. This is the people who are willing to buy from these sellers. This represents the people who are buying, customers who are buying. And this represents the amount of people who are willing to buy from or the amount of people who are willing to sell to the buyers. Customers, available liquidity. Now, in the other video, I said that prices move because the orders that are coming into the market exceed the available liquidity. In this instance, there's clearly more sellers than buyers, but still prices won't go down. Why? Because when these orders are submitted to the liquidity pool, they all get absorbed and prices don't move. But when these orders go to the liquidity pool, these orders exceed the amount of liquidity that's available. This is how the market works. That's the theory part of it. There's also another thing that I need you to understand. The concept of resting liquidity. And also imbalances in the market. These are your low of the day or high of the day. High and low of the previous trading day. Previous weekly high. High and low. Previous monthly high and low. Equal highs, lows, and also old swing highs and old swing lows. Now, with these areas of liquidity, it's important that you note that these areas are easily recognizable, also known as areas of support and resistance, right? And also, there are enough orders resting on top and below them, because there will be people who will attempt to trade the breakout from those areas, and also people who are trading the reversals and have their stop losses resting below or above them. And also, let's talk about imbalances, and then I'll combine the two concepts. An imbalance occurs when there's unfilled orders. When demand exceeds supply and price goes up, it means there were unfilled demand orders left at the origin. So what we will be interested in is the origin out these imbalances. So if you have a large movement towards the upside, this price has moved upwards because the orders that were here exceeded the orders that were here. There are still a lot of there's still a lot of buy orders that are left here that aren't filled. And if you know anything about trading support and resistance, you'll know that these areas where the market has turned, they act as magnets. So price will eventually go back to these areas to fill in the orders that were left behind here. So with buy orders, we know that as prices increase, the number of buy orders decrease, because as demand increases, as price increases, demand decreases. The opposite is true for sell areas. When you got a drop in price, it's because the amount of sell orders that were on that area exceeded the buy orders. Now, there's still a lot of sell orders on those areas that still have to be filled. And the market will tend to go back to that area to retest it, to fill in the sell orders that were left on that area. If you're in a situation where you have equal highs, for example, the market went up to this area. Now, if the market tests this area, or if the market has turned for the first time, there's still a lot of sell orders that are left here. If the market continues to test this area, the sell orders that are found on this area are going to be filled. So if, say, for example, and these are just random numbers, if initially there were 50 orders from that first turn that weren't filled, on the second retest, you're going to get 30 orders because there are 20 orders that were filled. On the other test, you're going to get 10 orders because 20 orders are filled. Now, if there's still a lot of buy orders on this area, right, and they exceed the 10 orders that are resting here, price is going to push above this area and create a new high. On this resting liquidity, know that there's orders resting above and below. For as long as the market tests, in this example, tests below this area, the orders here are going to get finished. The price is eventually going to move from this area, right? And then it's going to try to go for the orders that are resting above here and try to fill in these orders. If these orders that are resting here exceed the opposing orders that are coming into this area, price is going to change direction. But if there isn't enough orders resting here, price is going to continue going high. I hope that makes sense. So normally on these areas, because they're easily recognizable, this is where you find retail traders. So a retail trader will place a sell order here and place the limit order here. Whereas institutional traders are trading value over patterns. So now instead of trying to sell at this area over here, maybe they'll try to bid for higher prices. So if, say, for example, you have a watch that someone's saying, hey, I'm willing to buy this thing at $50. You are out here on some, hey, I'm not willing to sell this thing for less than $60 or for less than $80. If the people who are willing to buy here at $50, if there are no more, and there's still more people who want those watches, these people are going to be forced, if they really, really want those prices, they're going to be forced to settle for higher prices. And if you were here, if you are a bank and you say, I'm only willing to sell at this price, once the orders get filled here and the amount of people who have their watches here exceed the buy orders that are coming in. Now, because there's no one who's willing to buy, because all the buy orders are finished, they're going to be holding stock. And because of that reason, prices will drop. By the way, this is called a buy stop liquidity. Because the banks are going to use the buy orders that are coming into these levels to trigger their sell positions. And the opposite is true for when you have a sell stop liquidity scenario. Let me draw this. You have sells. People place their buys here. Now the buy orders here are going to get depleted. And then because they are depleted, the sell orders are going to be able to move past this area over here. Now, because of FOMO, there are retail traders who are going to be lured into selling this breakout over here. Now, if you sell this breakout over here and the stop loss is lying below here, large banks are going to use the sells that are coming into this area and the stop losses here to get liquidity to trigger their buy orders. This is why you get manipulation. Now let's go to a live chart and I'll try to explain this using a live market scenario. Remember, resting liquidity and imbalances. If you want, I'll also do a separate video on that. Then I'll explain. Now let's use this piece of the pie to explain. This is cash JPY. I'm recording this on the 17th of August, 2021. Now, let me start by looking at my imbalances. You see here, there are a lot of sell orders because of this large momentum candlesticks. Because of this large momentum candlestick. And like I said, we're interested in the source of this. So it means that there are a lot of sell orders that were left here. Buy orders got depleted. Sell orders that are resting here that were unfilled. Now the market is eventually going to go back into this area to try to fill in the sell orders. So this is where the turn actually occurred. When the market went back to retest this area where there are a lot of unfilled sell orders. But you have an example here of equal highs. Now, you got this bullish push to the upside, and then orders got filled. Sell exceeded buys, but then buys were still persistent. Sell orders that were here, right? And then the sell orders were eventually, exceeded the buy orders that were here, and then prices pushed down. Market went back to retest this area, but this area has already been retested 2 times. So now the people who are buying here are getting their orders filled from the sell orders that were resting here, and also the stop losses that are lying above this area. But then the amount of sell orders that are resting here exceed the buy orders that are coming in, right? And this is where you get the exchange. This is where large institutions have their orders. Now let's go back to customers. I mentioned that the customers are retail traders, tourists, and mutual funds and banks. On customers, an individual trader does not have an effect on the market, if we're being honest. So remember in the liquidity video, I made an example about a ball that's coming into a liquidity pool. If you have a small ball coming into a large liquidity pool, the ball will not have an effect. Now let's use monetary terms. If you have $2,000 coming into a liquidity pool of 200 million, do you think that $2,000 will have an effect on that 200 million? No. But if 500 million comes into a liquidity pool of 200 million, do you think that will have an effect? Yes. this is essentially why big money controls the movements of the market. Now, as an individual trader or as a small trader with small money, after you've realized that you can't or you don't have an influence over how prices move, you also have to make sure that when you place yourself in the market, you place yourself in the direction of big money, because they are the ones that eventually or essentially control how prices move. So if retail traders are saying we are selling here because it's a double top or it's because it's a level of resistance, right? If big banks are saying, no, that's not where we have our sell orders. We have our sell orders way above that area. Where do you think you're going to be most profitable when you trade? This area over here or this area where you have? So retail traders will have their stop losses here, and their stop losses will be taken out by these large banks for liquidity. Now, once you have a situation where the sellers here convert into buyers, retail traders convert into buyers, once they come into a level where large banks have their orders, price will turn because they're going to absorb all of the orders that are coming into that level. Another example of an imbalance is this one. And this is the source of that imbalance. Right here, you have a swing low. So buyers exceeded sellers, and there are a lot of buy orders that were unfilled here. And this is, I remember a few months ago, I talked about discounted levels, and I said that I'll try to explain them one day. As price increases, demand decrease. The lower you go, the more buyers you're going to find. So if here you have 80 people who are willing to buy, it means that the lower you go, you're going to find more people who are willing to buy, right? We're trying to think like the institution. Sell orders are going to come in here, right? And then they're going to fill in the buy orders that were found here. Sell orders are going to absorb the buy orders that are found here. When the retail trader attempts to sell the breakout, they're going to find a large pool of buy orders or buy limit orders that were resting here from large institutions. Now, once that money has been generated, price is going to continue going up. And this is a scenario of sell stop liquidity. The same thing happened here with a swing high. Market went up, went into a level where most of the banks had their orders, and then eventually turned. You have a swing low here. And then it hit your stop loss before moving into a certain direction. So this is one of the reasons why the market moves the way it does. Obviously, there's a whole strategy behind this. And this is why I created the series of the introduction to institutional trading. If you want to learn this strategy, or if you want mentorship when it comes to the strategy, you can contact us using the link in the description, and we can teach you how to apply the strategy in a profitable way. If you stuck to this point, hope this made sense. Hope you learned something useful. I hope you would use this information to improve your trading. Now, if you're a retail trader, what can you do to improve your trading so that you don't get stopped out? Say you're not comfortable trading supply and demand. You can literally just switch to wider stop losses. So instead of placing stop losses where everyone is placing stop losses, you can literally just widen your stop losses. And this is all I have for you guys. Thank you guys for watching. Till we meet again. Peace.